Welcome back to the Property Frontline. We're here today again to do Market Watch with Scott Hoaxang. Hi, Scott.
Hi, Deborah. Hi, all.
Hi, all. And this is one of our most favourite times of the year because Louis Christopher from SQM Research has just released his 2026 Boom Bust report. I think he's been doing these reports almost 10 years now, but we always are quoting the SQM Research because we think he's one of the best independent commentators and forecasters for the Australian property market. But he is quite unusual in that he will produce this report, release it always in November of each year, and then we usually see all the other forecasters kind of copy. So let's go through the report. But before we do that, we're going to look at what SQM forecast for the 2025 year. So let's just take a look at the way this is done. So first of all, we'll cover off the scenarios and then talk briefly about the numbers. So last year, Louis Christopher took as his base case that there would be a rate cut in mid-2025, and population was a huge, big influence in the 2024 year. So, of course, he was taking that into account for 2025. So he was saying, base case, there would be a continued increase in population. And then I'll just do the whole scenarios and Scott can talk about the numbers. So then scenario 2, there was no rate cut, which we're all holding out for because there hadn't been a rate cut for quite some time. And then scenario 3, he forecast a rate cut in the March quarter. Very good thinking there. And then scenario 4, population growth steadied. So, Scott, do you want to talk at a high level what the forecast was for 2025? Or do you want to just flip to the next?
I think we're going to jump to his actuals. I just want to say one thing about his methodology. I do want to commend Louis for basically pioneering this scenarios approach. Yeah. We really had never seen it before. Throughout the years, everyone puts out a point forecast, and Louis recognized circumstances change throughout the year. There's a lot of uncertainty in these global factors. And really was the first one out putting forecast scenarios out there that allow us to make changes and course corrections mid-year. So a little accommodation for that. Yeah,
based not only just on the numbers. So he looked at all these other factors that will influence pricing. Okay, so let me just get to the next one. Right, so performance for 2025. What do you want to...
Sure. So what Louis did was he shifted to his scenario 3, which was the early rate cut, which is what in fact happened, as we all recall. In fact, we got 3 rate cuts to kind of drive the market, and that bumped up his forecast toward the higher end. So I'll just go through kind of a couple of them. And what we've done is we've compared it to actual house prices from CoreLogic. And these are through the 12 months ending October 31st. So we've got a 1 year to 1 year scenario. We don't quite have the November and December stats in yet. So those CoreLogic numbers might bump up a little bit, but this is good for a comparison. So he forecasts Perth growing at 15 to 20%. Actuals came in a little above 9, and I do think that's going to end up probably being 10% plus. So he was a little too bullish there.
He loves Perth.
Yes, and he had been not as optimistic on Perth the year before, so I think there was a little bit of catch up going on there too.
Yeah.
The Brisbane forecast was 11 to 16%. Wow. CoreLogic had it at 10. And again, probably bumping up toward the bottom part of that range. Little old Darwin, which not a lot of us have paid much attention to until recently, 5 to 10%, and has delivered a whopping 16% growth. We can get into some of the reasons why that may be happening. And Melbourne, sort of one of the lower markets, 2 to 6%. It had been depressed for some time. The actuals have come in at 4. Do you want to take the next couple, Deborah?
Okay, yeah. So using Louis Christopher's scenario 3, he forecast Sydney to be up by between 3 to 7%. He was right on the money there. It's come in at about 5.1. Adelaide, he said, was going to bounce up by 10 to 14. So little off the mark there. It's come in at 6.7. Hobart, he was saying up between 1 to 5. It's come in at +2. Canberra, anyway, Canberra, Louis Christopher forecast an increase between 2 to 6%. It's gone up by 4.2%, so right on the knocker. And then capital cities generally, he said between 6 to 10% up, and it came in at 6.3 for the capital cities. And CoreLogic does record a national number, and that has resulted in 6.6 increase over the past 12 months.
Not bad. Do we want to give him a score on this, Deborah? I'm thinking maybe I'd give him a B+.
I was going to say 8 out of 10.
Okay, 8 out of 10. That's fair. Quite good, but it's all relative because, like I said, I don't think we'd have other forecasters we'd put up that would give higher than that. So
no, and we will talk about it later. But you and I used to. It was sport, wasn't it, to see what the banks would put out, and we'd just roll around laughing at some of the things they'd forecast. It was just so off the mark. And even literally the government forecasts, just ridiculous. Okay, so what is he saying for 2026? Will it be good? Will it be bad? We know because we did the stats. So this is what Louis is forecasting for 2026. Do you want to run through the scenarios? So this is what he's forecasting for 2026. So we're still using 4 scenarios. The first one, which is the base case, I'll just refer to them as SQM. SQM are forecasting a rate cut basically for 2026, sluggish economy and inflation to sort of bump along as average. Scenario 2 is sticky inflation, so no rate cuts until late 2026 and inflation starting to creep up, still sluggish economy. Scenario 3 he's got as an influence from outside factors, so as a reaction to anything that might happen with tariffs, etc. And so he's saying there would be a rate cut throughout the year and unemployment rising to 5.5. I mean, I can see that happening in Melbourne, but not in the other states at the moment, particularly not Queensland or WA. All right, and so scenario 4, an economic rebound with rate cuts throughout the year, lower inflation. Like you were saying, Scott, this is where things go into a dreamlike state. Goldilocks?
I call it Goldilocks scenario. Maybe Louis will put that in next year.
Yeah.
His dream Goldilocks.
Yeah, he has used Goldilocks scenarios before. But yeah, this is where everybody gets what they want. So is there a chance of that happening? I'm going to say no.
It does lead to the higher, property growth forecasts, and we'll see some of the higher numbers in that scenario. And we were talking before the podcast. We see the media, when they do grabs from this report, they'll selectively grab the most optimistic number. So they'll go to the highest scenario, take that highest end of the range, and all of a sudden that's their headline in the news. So everyone needs to watch out for that. And always do a deep dive, because I'm certain I saw a news source say Perth house prices are definitely going to grow at 20% next year. And that's where that number came from.
Yeah, exactly.
Be smart,
Um,
everyone.
mm, yeah, which is really, really crazy. But one scenario, and we will talk about it a little bit more later on, is the news that we're getting this week is that inflation has really peaked, jumped up. We've just switched to the new monthly CPI ratings where we used to get them quarterly. And if property prices are going to bounce this much, what's going to happen? Inflation numbers will go up, and then we'll have pressure on the RBA to increase the cash rate, and there's no scenario for that,
No,
is there?
I mean, no. Even scenario two with sticky inflation, it didn't have any chance of a rate hike. Although Louis does mention the possibility of one in the report, it did not make it into his 4 most probable scenarios.
Yeah. Okay, well, that's good. All right. So that's the highlight of what Louis is forecasting. So summarizing all of his forecasts and then comparing that to what other brave organizations are doing, this is what some of the other forecasters are saying at this point in time in November 2025. So, Scott, do you want to run along the first 4?
Sure, I can do that. By the way, this is a Market Watch exclusive. I don't think anyone else puts this combination of figures together. We do spend a bit of time to kind of pull all this together to get the information in a very concise format. So, just on the other forecasts themselves, by the way, the Domain report, I believe, was from August. Their house price forecast they put out in August, and Westpac and ANZ were, I believe, September, maybe October. So they're all quite recent forecasts in the last couple of months, and these are the ones that have been released so far. Back to the numbers. Louis' scenarios, the lower end of his growth forecast for Perth is 8%. And then we've got that super optimistic high end part of the range, 21. So 8 to 21, and our other forecasters are at 5% Domain, 8% Westpac, and 5.8% from ANZ. Moving down to Brisbane, we'll just sort of speed this up a bit. 8 to 18% is that range. Versus 5 from Domain, again 8 from Westpac and 5.6 from ANZ. So in both those two scenarios, I would say Louis is more optimistic than some of the forecasts we're seeing. Heading down to Darwin, he's got a pretty wide range here, and I think it goes to show you that the assumptions up there can change, and that is a very small market. 3% on the low end all the way up to a whopping 18% on the high end. Darwin's not actually covered by Domain or Westpac, at least in the forecasts. Too small of market, I guess. And ANZ has them at 6.1%. And I'll do Melbourne as well, which has a bit of a wide range, all the way down from just a small amount of growth, 2%, up to possibly a very nice year coming in at 11%. The other forecasters, Domain's at 6%. Westpac stands out here with quite an aggressive forecast for Melbourne of 10% that I would note. So they obviously have a bit more confidence in that Melbourne market than some of the other firms, and ANZ 6.6.
Would you say there might be a little bit of hopeful influence? Because isn't Westpac, isn't their head office in Collins Street in Melbourne?
That is very possible, Deborah.
A little bit of bias there.
And what they also own, St. George and maybe Bank of Melbourne too.
Yeah. Anyway.
Rolling over to you for the next 4.
Okay, yeah. So Sydney SQM has forecast an increase of 2 to 11%, while Domain more conservative, but still like a huge jump up at 7%. Westpac has Sydney at 8% and ANZ at 6.3%. Adelaide SQM is plus 9 to 18. I completely disagree with that, but, happy to be proven wrong. Domain has Adelaide going up by 4, Westpac up by 6, and ANZ up by 2.7. Hobart, I'll try and be nice. SQM has an increase forecast of 3 to 10%. Domain can't be bothered even looking at Hobart. And Westpac up by 4%, ANZ up by 2.1%. And that's off a really super low base. But anyway, and Canberra, SQM has Canberra still bouncing up by 1 to 9%. Domain forecasting 5%. Westpac not going to go there, and ANZ up by 2.2. Canberra, the clouds, the dark clouds are gathering over the Canberra property market. We'll tell you why in a moment. Capital cities, SQM has summed it all up. A general increase of 4 to 14%. Domain up by 6 and ANZ up by 5.8. But looking at that, have you ever seen a year where the forecast is so bullish? Can you remember that?
Not that I remember. And actually going into COVID, almost it was that negative. We saw that many negatives. So it's sort of the other extreme of everyone expecting growth. It's quite impressive.
Yeah. And I think that, I think they are on the money. From the Property Frontline, we're seeing much more activity really starting to bubble up. And even people who throughout 2025 were like, yes, I'm buying, not, yes, I'm buying, no, I'm not. Now they're all like, oh, forget it, I'm buying.
Yeah.
So
Are you finding, because I'm also seeing people's decision-making being faster too, like maybe earlier in the year, a bit more paced, a lot more study, really kind of dragging things on. And now people just want to get something bought in the next 30 days. Had kind of many like that lately.
Just generally, Scott, what are you seeing when you're buying for people in the market? You seeing more positivity?
Yeah, I think we've seen a change in the speed of people making decisions throughout this year. Earlier in the year, a lot more study, really taking months to kind of decide on markets, and then even property options, often missing out on opportunities because they just weren't prepared to jump. Lately, in the last couple of months, we've seen people coming in, acting quickly, saying they want to have something bought in the next 30 days. Now, as we're getting close to Christmas, a few of those have been successful in doing that. And, I think they're thinking we may be looking at an even tighter and tougher market in early 2026. I don't want to be in with that mob. But what do you think, Deborah, with your crowd?
Yeah, so we're definitely getting that kind of reaction as well. So people are really, like I was saying, those people who were undecided throughout 2025 are now right, that's it. I'm definitely buying. Let's get it sorted. If not, in the next couple of weeks, certainly in the first couple of months of 2026. And what I'm also seeing is that little bit more vendor confidence. Property owners are now going, okay, I think I will put my property on the market because it has increased in value so much and I don't want to miss, the opportunity to sell now. Yeah, so that just means that we're actually starting to get a little bit more trading.
I will add one thing, is just because I'm across the new property space. We've seen reactions from builders and developers. They are tightening up their terms. There isn't a whole lot of flexibility in terms of wanting finance clauses.
Yeah.
You always know a market is heating up when there's a lot of pressure from that part of the business saying, if you want to buy this property, you need to sign a contract, move quickly. It's just not a whole lot of flexibility at all. And that's been the way that it has been in the past 2 months. So, yes.
Okay. Alrighty. So what we need to do is get out our binoculars and make sure we're actually looking at what's going to happen over the coming market, really, from our perspective. Now, this is really, really important because it will help us decide which way to read the SQM forecast. And Scott and I have to make these decisions really before any of the forecasters actually get the message. So because we are buying, we're actually shaping the market. They get the information they get the data that we've already created by doing the buying. They get that data about 8 weeks after us. So we really need to keep our finger on the pulse of what is shaping the market. So SQM, in preparing their data, he was focused on assuming the RBA does drop. He didn't factor in, like we were saying, a scenario where there was lifts or increases in the cash rate, and potentially many. What's your feeling right now, Scott, for 2026?
Well, my gut is we are starting to lean toward having a rate hike now. That inflation number was a little unexpected.
Yeah.
So I would say, the odds are increasing of that, which will reduce some of these growth forecasts.
Yeah.
There's a lot of market volatility out there right now as well. For those of you following the stock markets and crypto, I did write some numbers down here. There was a plunge in Bitcoin of 33% over a 6-week period recently.
Yeah.
Kind of crazy. Stocks were down about 5% in the month. So there is a lot of volatility out there that really was not picked up in one of these scenarios.
Yeah, but not volatility in the property market because it takes longer for those sorts of things to play out.
If anything, that almost reinforces the growth numbers that, yes, as we don't actually have that as a point down here, but volatility does tend to push people towards stability, and property has been that stable asset class for decades here in Australia.
Yeah. Okay. Alrighty. So back to SQM's assumptions and influences. No major election impacts, so we don't have to figure out, what is Labor giving the market, what is Liberal going to give the market. It's nice and clean from there. Not factoring in any pressure on population, so we're expecting more stable population. Who knows? Still tight supply, still a problem. Starting to consider selective regionals, which we'll talk about in a second. So this is really the first year that I've seen or I've noticed SQM actually go, well, there's some regionals that are now starting to almost become new capitals. And then, of course, government assistance for first-time buyers will be a solid influence. All right, so this is what Scott and I actually see as the trends starting to emerge now in 2025 that we will see influence the market over 2026. So the rise of regionals, I just really see this as one of the biggest changes. So Scott, you've been in regionals for a couple of years now.
Yes, that's right. And we started with the coastal regionals, but they sort of got, expensive so quickly following the capital cities. We have started looking at some inland regionals, and it's price point focused and project based.
Yeah.
Just strong economies out there, and you can see the population growth occurring. Spent a lot of time, actually, I'll just mention one out in Tamworth over the past 18 months. And I've just watched that economy really, really take off.
Yeah. Yeah, and a couple of those coastals for like your duplex projects and things, amazing. Okay, yeah, from my perspective, because I buy established properties, there is such a huge, strong market for sub $600,000 purchases. That means that there's some really great locations, and I'm not talking about Darwin, like I would buy in Darwin selectively, and for a very good reason, but like I'm driven by what my clients need. So we're very selective according to what the clients require. So that means that if there's a suburb that, say, some area or some forecaster is saying, be very careful about Ipswich, we might be still looking in Ipswich because we've found a great property that meets a client's requirements and the numbers really work and it's going to be amazing. So, but getting back to locations for the sub 600 buyers, there's like a really great source now of places where you can buy and get really good rental return with really good potential for adding value. And then the other thing that we see coming for 2026, rising inflation. So we have just this month changed to monthly CPI instead of quarterly CPI, which is going to give the RBA much more nuanced data. And so this will be a good thing, though it was a big shock. Of course, inflation is going to bounce up just before Christmas. Like, is that not crazy or what? But do you have an opinion on that or not?
Yeah, I think it was also sort of self-manufactured by the government because they gave all of us electricity rebates throughout the year, and those have been phased out. So they were sort of able to buy down the inflation rate and maybe make it look a bit better. And that candy's now gone away. So we're back to paying full freight on electricity.
Yeah.
Yes.
Okay. So there is, with rising inflation, there's high potential for interest rate rises. The RBA is going to have to pull back on that stick. Tight supply, still talking about that, still will be for a little while. What I really think is going to happen, the government will eventually get that supply starting to chug along, and then we'll eventually, I'd say maybe we might be talking 5 to 10 years' time. I reckon they'll get to a point where we are in a little bit of oversupply, so we will be watching out for that. Then, government assistance for first-time buyers. So you were talking earlier, Scott, did we say it on air or in the prep that that you think the FTBs will start calming down, or it'll just be absorbed by the market?
I think a lot of them are going to be buying in the next 6 months, and then you probably will have some reduction. Effectively, they're pulling forward the demand. People that might have bought 1 and 2 years out, all of a sudden can now buy with just a 5% deposit. So causes a faster rush in a shorter period of time, and maybe the second half of next year we'll see fewer of them.
Yeah, but I think the sanity has returned to the purchase prices because there was some excitement saying, this is really going to push property prices up. But then when first-time buyers started to actually look at the numbers, look at the repayments, they're like, oh, no, I have to revise my budget back down to a more reasonable number because I've got to pay the thing off. So, yeah. Okay.
And the banks are there as a governing factor as well. Just because you have a small deposit and they've given you this much higher price point to buy at, you still have to be able to service a loan and get that, across the line with your bank. And unless your incomes are, dramatically rising, you're going to be capped at a certain level.
Yeah, exactly. And now this last point, just something that has come up this week. Federal Labor is now starting to look for budget savings. And what are they looking at? Their employment numbers. And so once they start looking at that, it means that people are going to start to be moved out of their roles. And it's a big red flag for Canberra, which I've always said, and I'll keep saying it. Canberra is a one-employer town. Yeah. It's like a mining town. And so if federal government decides to start cutting staff, that means people have got to sell off and move. So I think those people who were forecasting good increases for Canberra, it's not going to look good, but whatever. Any comments to make about that?
I'll just add one final point just on construction and build costs. I think we are seeing further build cost rises, as expensive as it is to build in this country. I just am not seeing things change that are going to have that get reduced. There's more and more requirements the governments are putting on these builders. We're watching the ones we're working with, with a hawk's eye, basically. And if anything, we're working with fewer builders going forward. It's quite a challenging space.
Yeah, it'd be so good if we saw more of that prefab building come through, because that does bring costs down a little bit, but that's at least 12 to 18 months away. Alrighty. Okay. So, as usual, our normal tips: when you're looking at data, make sure you watch out for misleading information. So, data that doesn't give you the full picture, that might be influenced by someone who's trying to sell you something. And so you're better off just making a sense check, go back to SQM. You can always look up the numbers free on their site. And the other really good sites are realestate.com, Domain. All of that stuff's free. Use trusted independent sources. Always conduct the financial pros and cons for any property decision you're making, and use criteria that's tailored to your requirements. So the person next door to you will have different goals and will be matched to a better, to different property to the one that you would be better matched to. So my explanation for that is I like property that I can do things to, whereas if you're really, really busy, you might like something that doesn't need any repairs or any improvements made. No, what I'm going to do. Right. So what else to consider? The SQM report that we have just been talking about at a very high level. You can actually buy the report. We never make recommendations about spending money on reports or anything like that in this podcast, but this is one that we would recommend, and I think it's like $70 or something. But yeah, so just, we should announce Scott paid for his report. I paid for mine, so we did.
Absolutely.
Anyway.
Louis and his team need to eat too.
That's right, exactly. And look, it is a really good report, really covers a lot of different aspects that we didn't have time to cover here. And they do start to go into some more detail about stock on market and vacancy rates. So it's like if you want more detail, definitely grab that report. We will have a link in the description. If you would like some help deciding where to buy or what to buy, you can find Scott on his Facebook page, so Scott's Property Coach. And if you would like some help from me and the Property Frontline, you can utilize our Buy Like a Genius service, which is our end-to-end service where we'll help you with strategy, where we'll shortlist and assess the properties, do the full negotiation, or represent you at auction. And once again, details will be included in the description box. And then tune in again to see us in a couple of weeks, actually, where we will cover off the Australian property market performance up until the end of November, and we'll also include our In Focus session of what you might consider when you're thinking about buying in holiday locations. This was a topic suggested by one of my favourite clients, Nathan. Thanks for the suggestion. So yeah, tune in for that and give us a like if you've enjoyed this podcast, and also subscribe if you want to be notified of the next episode. Okay, so with that, that's it for us for this episode. Thanks so much, Scott.
Great.
And we'll look forward to catching up again next time. Bye.
See you in a few weeks, everyone. Goodbye.